Hi, I'm Gerrie Cilliers, Wealth Manager at PSG Wealth R21. Now we deal with investments every day. I would like to use this platform to help you understand some of the finer details in the investment landscape and guide you through some of the things that we deal with on a daily basis. Hi, I'm Gerrie Cilliers, Wealth Manager at PSG Wealth R21. Today, I'm going to talk to you about the investor behavior gap. Market volatility has increased lately, and so has emotions around investments. But are you a risk to your portfolio? The behavior gap refers to the difference between the potential of a client's investment portfolio and the actual returns experienced by the individual client. It highlights the impact of investor behavior on the outcome of investment portfolios. During market cycles, bull and bear markets, investor behavior plays a significant role in the end result of investments. The behavior gap arises when investors make irrational and emotional decisions that deviates from their long-term investment strategy, and this leads to suboptimal portfolio returns in the long term. A few factors that contribute to the behavior gap are: number one, emotional decision making. This happens in market up and down swings. Investors can get overly greedy or get overly scared. What you need to do is stick to your long-term investment strategy and you have the best chance of things turning out the way you intended it to. Number two, herd mentality. Do not feel compelled to follow the crowd. This also happens in specific investments that rises fast and people get fear of missing out, and they tend to follow the crowd without doing research on the fundamental values of the underlying assets. This also can lead to suboptimal investment returns in the long term. Number three, market timing. Timing the market consistently is extremely difficult, even for professional investors. Generally, when you try to time the market, it leads to increased transaction fees and generally to the destruction of capital in the long term. Stick to your strategy. Number four, overconfidence and confirmation bias. Sometimes investors have some information on the markets, which leads to overconfidence and taking too much risk in the market. And also, confirmation bias is when investors have got certain ideas in the market and they look for specific information supporting that idea, ignoring contradictory facts that might lead to better decision making. And number five, a lack of discipline. If you don't have a disciplined strategy, market fluctuations will lead you to make short-term decisions based on unnecessary fluctuations in the market. So the best you can do for yourself is stick to your long-term strategy and ignore the short-term movements in the market. Now, the behavior gap highlights the importance of taking a rational, disciplined approach to investing. It's about doing a few things right and avoiding large mistakes. Like Benjamin Graham said, it's more important how you behave than how your portfolio behaves during market cycles. If you need any assistance or would like to have a conversation with regards to your investment portfolio, please reach out to us and we would gladly assist.